As you have just mentioned, as the NSE 20 share index continues to slide, of course, the excitement is shifting to the bonds market, where the government has just auctioned a 25-year bond. Joining us in studio is the expert now to take us through the finer details of the excitement in the fixed income front. Thanks for joining us, Fred.
Thank you, Terryanne.
Now, this is the first time in 40 years that we are seeing a 25-year bond. What are some of the market conditions that were there 40 years ago that have called for the same action in such a long time?
Thank you, Terryanne. Just as you have just correctly stated, this is indeed a momentous occasion in Kenya debt market industry, because for the first time the government has actually auctioned a 25-year bond to the market. Now, this is the longest bond so far we have of any type, corporate bond or government security. It's interesting to note, first of all, the circumstances that make it favorable for the government to float this bond right now are, for example, stable prices, stable inflation. Remember, for quite a long while we've had inflation figures of above 20%. It's making it very difficult for people to actually price the bond appropriately. Now we have inflation figures of below 4%. So it's easy now to look at a longer term paper. Secondly, because inflation, most of these yields of bonds have really been depressed due to a lot of money circulating in the economy, we find that interest rates have really gone down. And the default risk on longer term papers, because it's the same government, people now are tending to, uniformize the default risk on tenors of bonds. So irrespective of the tenor of the bond, as long as it has a good yield, investors are likely to go for it.
Now, the central bank governor, Professor Njuguna Ndung'u, is clearly very confident of the bond markets. What are some of the things that you would say he has done in terms of deepening the capital markets and making it more attractive?
For the past 1.5 years, we've seen regularization of the yield curve. For example, establishing benchmark bonds, 2 years, 5 years, 10 years, 15 years, 20 years, now 25 years. And most of the issues in the past 1.5 years has been targeting towards the benchmark bonds. One, reopening of previously issued bonds. Secondly, issuing new bonds within the benchmark bonds.
Now, the 20-year bond that was offered in 1997 was largely ignored by the market. What are some of the reasons that they ignored it that will not be factored in this 25-year bond?
The chief one I can think of right now is inflation. 1997 we had inflation figures of between 20 and 30%. Now we have inflation of about 3.9%, auguring very well for people to price the bond and actually getting positive inflation-adjusted returns. Yeah.
So 7.5 billion shillings, but you're of the opinion that the government could have actually raised more and that the market can absorb more than that?
Yeah, actually, previously we've been seeing subscriptions of about 20 to 30 billion on every new offering, bond offering. For this time, the government is just offering 7.5 billion. It's far too low than what the market can absorb. So we're expecting a scenario where interest rates are likely to decline further.
Now, debt of this kind seems better placed for take-up. That's compared to the syndicated bank loans. What do you see as the immediate possible impact this will have on the banking sector?
Two scenarios I see. For example, as the 25-year is going to come out, we expect that the rate will be perhaps maybe 10.5 to about 10.9%. This will adjust the rest of the yield curve downwards. Holding government paper is likely to yield less and less returns. So we're likely to see bankers considering going out and lending to the private sector. That being the case, perhaps we in the next, say, 6 months, we expect more corporates to either come to the debt market, both bond or going to banks, and banks are going to find it a bit more lucrative lending to the private sector.
Now, analysts have spoken about a fear of exclusion when it comes to borrowing from the fixed income front. Is this likely to occur this time around?
I would imagine you're talking about government excluding private sector.
Yes.
As the yields continue to subside, the crowding out effect is likely to decline as well, as the lenders of money are likely to start considering other options which are more paying. For example, government, we know, is risk-free instrument, but the yield is so low. So we are likely to see people taking care of the risk but looking for better returns. So likely scenario, banks will go out and lend to private sector.